On a daily today, you get a sense that many stocks have indeed gotten ahead of themselves after a very strong rally. When you've had major run and companies report terrific quarters, yet their stocks go down, that tells you something is wrong with those stocks, not with the companies themselves. A broken stock and a broken company are two very different things. And there are plenty of stocks today that broke, with the Dow tumbling 334 points, S&P sinking 0.53%, and the NASDAQ losing 0.93%, although we did climb out from an earlier hole. Now, a lot of people struggle with this whole concept of a stock being somehow different from the company it represents. It's easy to confuse the two and misread the action. But a whole bunch of stocks got clobbered today because of what we call profit taking. You know what? I find that term profit taking wanting. I bet you do too. So let me tell you what I do when I analyze a company on earnings day, and I do it in the quiet, okay? I don't look at the tape, so to speak. I don't see where it's trading. I just analyze it straight on. Take GE Vernova, General Electric's old power business, which reported this morning. GE Vernova is a very important company because it's responsible for plurality of the energy that goes into, yes, you guessed it, the data center, because they make the gas turbines that make so much of the energy occur. I saw the numbers come out over the wire this morning, and I immediately liked them. Company showed excellent order growth as it's become integral to the need to feed these data centers an extreme amount of electricity. They are gigantic gigawatt consumers, and GE Vernova is one of the very few companies that can generate enough power to sate these hungry behemoths. While the CEO, Scott Strachan, didn't raise estimates for the full year, he did paint an incredibly positive outlook on the conference call. The story only got better when CNBC's own Seema Modi talked to Scott, and he said that he'd been in contact with OpenAI's Sam Altman. Sounds like a big relationship could be in the offing. Every time some company announces an agreement with OpenAI, its stock tends to jump. That's what happened to AMD. That's what happened to Broadcom. That's what happened to NVIDIA. Maybe GE Vernova, which we own for the Child Trust, maybe it could be next. There's only one problem. GE Vernova stock was already up almost 80% for the year going into the quarter. The stock was indicated up 25 points before the market opened, but in the end, management didn't raise their full-year forecast, and when your stock's up nearly 80%, you need to raise high the roof beam carpenters. Anyone know that book? It's pretty good. Next thing you know, GE Vernova is down 50 points. It wasn't enough that you had terrific order growth. The stock had already anticipated that, and more. We didn't get more, so what happened? Sell, 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 sell. Now you got to ask yourself, is GE Vernova a bad company? Did it do something wrong? No, not at all. In fact, if you looked at GE Vernova stock in a vacuum, you'd want to be a buyer at these levels. A lot of people clearly agree with me because the stock erased most of its losses and finished just down $9. Okay, sounds a lot, but not on a $576 basis. No tragedy there. Stock wrong, company right.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.